Well, Jagindar Rana here. Topic of the day is surety bond is a risk transfer mechanism. Surety bond is a risk transfer mechanism. The Insurance Regulatory and Development Authority of India has formed a task force to address challenges and drive the growth of surety bond insurance. The task force comprises representatives from insurance companies, banks, and reinsurers. The Insurance Regulator and General Insurance Council brought key stakeholders of the surety bond market together at a surety conclave to discuss key aspects including collaboration between banks and insurers, data sharing, and expanding the scope of surety bonds. Surety bonds play a crucial role in supporting India's infrastructure development. So, by addressing the challenges and fostering collaborations, India can unlock the full potential of this valuable financial instrument. A surety bond is a risk transfer mechanism whereby an insurance company provides a guarantee to the beneficiary that the principal or contractor will meet their contractual obligations. There is a need for regulatory support and industry-wide cooperation to address issues such as the right of recovery by the Ministry of Corporate Affairs, the status of secured creditors, and the need for faster court settlements. So the industry also want to solve various challenges including regulatory parity, enforceability of surety, indemnity agreements, and data access and data sharing agreements. In terms of regulatory parity, industry participants are advocating for equal legal recourse for insurers under the Insolvency and Bankruptcy Code as enjoyed by banks. So they are also seeking to strengthen the enforceability of agreements between insurers and bond beneficiaries. Efficient data sharing between institutions is also considered a key concern. The collaboration between bankers and insurers coupled with seamless data sharing will be key to taking surety bonds to the next level. For the formation of a task force is a critical step forward in ensuring that surety bonds become a cornerstone of India's infrastructure growth story. So as far as the surety bond launched less than a year ago have still not become popular as financial instruments, there are some issues associated with their adoption and a growing demand for changes in the governing legal framework to strengthen rights of stakeholders. As a matter of logistics, contractors tend to be in more regular contact with banks for a variety of financial needs as compared with insurance companies, so which do not have a regular interface with contractors. This points to the deficit of information regarding the availability of such products. Contractors may also lack expertise in dealing with such specialized financial products, including analysis and negotiations over favorable terms. So when given a choice between well-established bank guarantees and a new product, contractors may gravitate towards the known in the absence of any remedial intervention. So the industry, at the behest of the Ministry of Road Transport and Highways of India and other relevant authorities, may carry out soft interventions such as promoting awareness, training sessions for contractors. Additionally, the insurance companies could collectively create an awareness and outreach campaign. So to facilitate effective dissemination of information, the Ministry of Road Transport and Highways and other authorities can facilitate required contact between contractors and insurance companies. Thus, collaborative efforts by the industry and the government could remove the lack of awareness regarding surety bonds. Globally, insurers take certain factors into account for providing approval to select contractors. That is, capital analysis of financial statements, capacity analysis of work history, and character analysis of contractor reputation. So the cost of a surety bond tends to be market driven and can vary based on the underwriter's assessment of risk associated with a contractor. So surety bonds are also priced using actuarial analysis, which relies on past data to ascertain the likelihood of default and the bond being called upon, so that pricing can be adjusted for possible losses and costs. Also, this is a new product. This data is absent from the Indian surety bond market, which poses a pricing challenge for insurance companies. For other insurance products, reliance on international technical experience in underwriting and pricing helps overcome this challenge. This strategy may not be directly transferable to the Indian context. So this would mean that certain losses may have to be incurred by insurance companies and written off to gather data and eventually see success in this product. Additionally, contractors and insurance companies appear to have a mismatch in expectations with regard to the pricing range of surety bonds. But the insurance companies have indicated that surety bond purchasers' unwillingness to pay adequate premium or provide collateral has made it difficult to launch the product. It has also been pointed out that insurers may find it unsustainable to offer surety bonds at a cheaper price than bank guarantees, especially because it is new and not much historical data is available. So for insurers, the economic viability of surety bonds may be doubtful without the financial comfort of pricing, collateral, and reinsurance. As surety bonds are a new and untested product, it is likely that insurance companies would require certain facilitating elements such as reinsurance support and collateral to provide surety bonds. Insurers may even require premiums that are not substantially cheaper than bank guarantees, especially until the product takes off and they gain more experience. So for insurance providers, these considerations are crucial from the perspective of maintaining solvency and pursuing profitability. The 2022 guidelines address issues of risk mitigation for insurers by prescribing an underwriting philosophy with the restrictions on solvency ratio and management of exposure. Our insurers will be likely to manage risk through high pricing of the surety bonds, which they can mitigate only if in possession of adequate risk-related information. Risk-related information. So, the working group suggests that collaboration between insurance companies and banks likely to have existing records, creation of a centralized database for information related to surety bonds. This may assist insurers in collecting information regarding the contractor's key financial indicators, credit history, and working capital conditions. Additionally, NHAI too could have or could make the data available for creation of centralized database. Now the conditionality of surety bonds is also important because the encashment of bank guarantees is well settled and leads certainty to project owners, allowing for relatively smooth conduct of commercial transactions. Global experience has shown that enforcement of a surety bond is fraught with more difficulty. So as an insurance company, the surety is generally required to be convinced of the underlying default before it admits liability. So this is in contrast to bank guarantees, especially unconditional bank guarantees, which can be practically encashed on demand. So to convince itself of the underlying default, the surety usually investigates the project, halting construction for a lengthy period, leading to delays in the overall timeline. If the surety denies liability, legal action may follow, and the surety would retain its funds until a decree, halting operation further. So the certainty found in litigation involving bank guarantees may also not be found in litigation over a surety bond, considering this financial product is quite new in India. Thus, the conditionality and associated cost of surety bonds are another challenge to its wider acceptance. So, addressing the challenges posed by the conditionality and associated cost of surety bonds requires a multifaceted approach. Surety bonds are essential for India's infrastructure growth, according to the IRDAI. So the importance of overcoming challenges and fostering collaborations to fully utilize this financial tool is required. Because insurance surety bonds act as financial guarantees, ensuring contractors meet their obligations. These bonds involve three parties: the surety, the insurer, the principal, that is contractor, and the obligee, that is often a government entity. So the surety provides a financial guarantee to the obligee that the principal will fulfill their contractual duties. The General Insurance Council noted several obstacles, including unequal legal recourse for insurers under the Insolvency and Bankruptcy Code compared to banks, and weak enforceability of agreements between insurers and bond beneficiaries. So to tackle these issues, a task force has been established. This group includes representatives from insurers, banks, and reinsurers. Their goal is to develop strategies for risk sharing, improve collaboration between banks and insurers, and create a supportive environment for the growth of surety bonds insurance. The collaboration between banks and insurers, coupled with seamless data sharing, will be key to taking surety bonds to the next level. Forming a task force is crucial for making surety bonds a fundamental part of India's infrastructure development. So this initiative aims to ensure that these bonds become integral to the country's growth story. Addressing challenges and fostering collaboration are vital steps towards unlocking the full potential of surety bonds in India. The formation of a dedicated task force marks significant progress in this direction. Thank you very much.